In this video, we're going to talk about something called the gross profit margin ratio. Now, you might be wondering, why do we need the gross profit margin ratio when we can just calculate a company's gross profit margin and then compare it to the gross profit margin of another company? Well, there's an important reason that we can't do that. So let's just assume here that you started your own grocery store, and then you're trying to put this competitor out of business, and you want to make some comparisons about the gross profit margin. The problem is that this competitor has a lot more in sales than you do. Now, that could be for a number of reasons, but one reason is it could be that they have multiple stores. Maybe you only have one grocery store and they have two or three. So we might be dealing with a much larger scale of operations than what you have. And so we want to be comparing apples to apples here. So what we want to do is we don't want to just say, okay, well, this number here happens to be larger than this number, so therefore this competitor is doing better. That's not necessarily the case. What we really want to track is, for every dollar of sales that comes through your store, how much of it eventually ends up going into the gross profit margin, and then track that same thing for the competitor and compare. And that's why we calculate the gross profit margin ratio. So let's go ahead and calculate that. The way we do that is we take the gross profit margin of 4,000 and divide it by their sales of 10,000, and that's going to yield 0.4. Now, what does that mean? That means that for every dollar of sales that comes through this store, my 4 looks terrible. For every dollar of sales that comes through the store, 40 cents of it ends up coming down to gross profit margin. Well, now let's compare that for our competitor. Let's see how they're doing. So we're going to do the same thing. We're going to take the 11,000 in gross profit margin, and we're going to scale it by the firm's sales, which is 20,000. And what is that going to yield? Well, it's going to give us 0.55. So that means that for every dollar of sales that our competitor has, 55 cents of it goes to the gross profit margin. So not only do they happen to just have a higher gross profit margin, but they have a higher ratio, which is even more telling. So does this mean that they have just better operations than us and we should just close up shop and we're doing a terrible job? Well, not necessarily. So it might be that this is indicative of the fact that maybe they're getting volume discounts for larger orders of groceries because they happen to be a larger store. You know, they're buying more biscuits and stuff from their vendors, and so they're getting better prices. The more that you buy, sometimes you get a volume discount. So it could also be that they have a completely different product mix than us. They could be using generic products, whereas we're using name brands. Maybe they are using a different inventory assumption. They might be using FIFO and we're using LIFO. And in periods of rising prices, that might actually end up where we are taking this hit to our gross profit margin ratio compared to them. Now, it could be indicative, though, that there is a problem. For example, it could be that our employees really like to steal our groceries, and they're in the back room having snacks and stuff, and then we've got a problem with something called shrinkage. Or it could be that we're having to throw a lot of our groceries away because we're not doing a good job of buying the right amount, and some of it is spoiling, and so we're having to write it off to cost of goods sold, these losses. So there's any number of reasons that we might be having actually this lower gross profit margin ratio. And we have to, what this really tells us when we see this difference, doesn't necessarily say, okay, well, our business model is terrible. What this is this is a flag that tells us, okay, we need to go and do some investigation and see why their gross profit margin ratio is higher than ours. And this ratio gives us a lot more information than just comparing these two raw numbers, which are really just going to tell us that that our competitor happens to have a larger scale of operations than us. We really want to know how efficient we are at transforming sales into gross profit margin, and that's what the gross profit margin ratio tells us.